Welcome to Chapter 5 of my Business Innovation series. Last time we talked about unit economics and customer profitability. Now, what if I told you that even businesses with fantastic per customer profits can still run out of cash, struggle to scale, or even fail? The invisible and crushing weight of their fixed costs and the strategic issues in bad CAPEX decisions can be lethal to a company. I'm Roland Umlauft. I'm an independent consultant and strategic CFO. I hold a PhD in finance and a degree in engineering, and I advise both startups and corporate innovation projects on how to build profitable businesses around their technological innovations. In today's video, I will show you how a high fixed cost business is different from a business with mostly variable cost, and how to keep an eye on those costs to make sure that your business is profitable. So let's dive right in. What are fixed costs? Fixed costs are expenses that don't change with your sales volume or your production level. It doesn't matter if you sell 1 unit or 1 million, those costs remain relatively constant. These can be rent for your office or rent for your factory, salaries of non-sales person or production staff. It is crucial to understand your fixed cost base because it determines your break-even point. So that's the level of sales that you need to cover all your costs, including those fixed costs. Failure to manage this can lead to losses, and it can lead to significant financial distress, even for any established player. As an example, let's consider WeWork. This is really a prime example of how fixed costs can lead to big vulnerability of a company. Their business model relies on signing long-term leases for prime office spaces. So these are massive fixed costs for the companies, coupled with significant capital expenditure for the build-outs and the renovations. And then they're subleasing that space on flexible short-term memberships. When their membership growth became sluggish and volatile, their highly variable revenue couldn't cover these immense fixed costs that they're having because of their business model. That mismatch ultimately has led to significant financial distress and a dramatic reevaluation of their entire business model and of the company valuation itself. This is a powerful example of how critical the balance between fixed commitments and revenue stability really is. For businesses operating in high fixed cost industries, strategic management of these costs and of their revenue stability is absolutely paramount. A key focus has to be on maximizing utilization and capacity management. Every kind of idle machine or empty seat directly will impact your profitability as the fixed costs are continuing to accrue. This often means driving towards higher sales volumes, optimizing operational efficiency, or even exploring strategies to diversify revenue streams or secure long-term contracts to ensure a stable cash flow. Fixed costs being harder to adjust in the short term, optimizing variable costs can improve your contribution margin. So this can provide a little bit bigger of a cushion to absorb those inevitable fixed expenses. When we're talking about fixed costs, we also need to talk about, your investments or your CAPEX. CAPEX stands for capital expenditure, and this is basically any kind of investment you're making in long-term assets that are expected to provide benefits for more than, let's say 1 year. So think about purchasing a building or purchasing land or investing in machinery, equipment, developing a software platform. CAPEX is not considered to be an immediate, cost as such. Instead, it's capitalized. It goes on your balance sheet as an asset. And this asset is then depreciated or amortized over its useful life. As I mentioned earlier, the amortization of CAPEX has to be counted as part of your fixed cost calculation. When it comes to your CAPEX investments, we also often have a choice and can potentially outsource instead of buying or building something ourselves. It's this idea of, do we have an investment where we buy something and pay for it up front, or are we leasing it? Think about buying a laptop or renting a laptop. This is a strategically critical choice, and especially when it comes to larger investments in tech or manufacturing, for example. Take a software company needing computing power. Do you invest in CAPEX to build your own data center, or you use OPEX by outsourcing to a cloud provider like Amazon Web? Or for a hardware startup, do you build your own factory versus partnering with a contract manufacturer? These choices obviously require very rigid financial analysis, but the principal pros and cons are the following. CAPEX offers you full control. It's your asset, and potentially lower long-term costs. It also demands high upfront capital and high upfront investment, and it reduces flexibility when it comes to increasing or decreasing your production scale, for example. OPEX, on the other hand, provides that lower upfront cost. You don't have to make that upfront investment. You're having much better flexibility. You can add a second provider, for example, or you can scale up with your existing provider if they have the possibility to do that. It allows you for a much faster time to market in most scenarios, because you don't need to make the investment, implement, and then you can start producing. You can go to this, manufacturing provider and start producing tomorrow if possible. At the same time, you will have less control, and you will have probably higher ongoing costs. This decision will profoundly impact your balance sheet, your cash flow, and your agility. And it is something that you cannot take lightly. It really depends on how much money do you have to spare, and does it make sense to own this asset from a strategic point of view or not? How are we able to manage our fixed costs and CAPEX? First of all, let's look at the break-even point. So the idea here is that how many units do I need to sell? How many customers do I need to attract in each period in order to cover my total fixed cost? Remember last time we were talking about unit economics for subscription models, and I told you that if you have these long income streams and there's different costs in different periods, I recommend that you write out your unit economics in a cohort view. So you're basically mapping each customer on a timeline where you're saying, okay, I will incur a certain cost at a certain period, and this is how much money I will make from that customer, and then subtract one from the other, and you're getting your net contribution or your net LTV from this particular customer. Now, once you've mapped this out on a timeline, and you're now going to look at period profitability and fixed cost coverage, how do you do that? How do you, assign your fixed cost against these customer cohorts? The way I do this normally is I would take an entire cohort and take the profitability of that cohort and basically map it against fixed cost from the period in which that cohort was acquired. So what we're looking at is, if we're signing up 100 customers this month, is the income that these 100 customers are going to produce for us at a unit economics level enough to cover the fixed costs that we're incurring in this period? Obviously, there are certain cash flow considerations that you need to make, but just from a pure profitability point of view, this gives you a very good indication of, how many customers do I need to attract at least for each of my periods in order to break even in that period. And if you keep on doing that, each period with their fixed costs will have their cohort of customers that pays for that fixed cost. Keep in mind that there are cash flow considerations, but we will be diving into that much later when we're building financial models. Let's look at your CAPEX ratio. The formula here is your revenue divided by your CAPEX. This shows what proportion of my revenue am I reinvesting into long-term assets? A high ratio of reinvestment might indicate very aggressive growth or, a lot of, significant infrastructure needs. Do you actually have that kind of cash available in order to make these investments on a continuous basis? How can I assess my CAPEX ratio compared to industry standards? The CAPEX ratio varies wildly by industry. So there are asset-heavy industries like manufacturing or logistics, and they will have a much higher CAPEX ratio than something that's a more asset-light business like a pure software SaaS. Even though with software, is still spending significant amounts of money on R&D and development. Another metric you want to look at is your fixed cost coverage ratio. The formula here is your fixed cost divided by earnings before interest and taxes. This measure basically is to show your ability to cover fixed costs with your operating profit. Imagine you have high fixed costs and your sales drop by 20%. Are you still able to, absorb these fixed costs? Typically, a ratio of 1.5 or higher is super healthy. I would again recommend that you build a dashboard to track these metrics over time. That way you can keep an eye on your fixed cost creep, and you can make sure that you have a good sense of your break-even point and if there's anything that has changed over time. Okay, let's discuss a few common pitfalls when it comes to fixed cost loaded business models. First one, underestimating a fixed cost it's in itself. So especially as you scale, fixed costs have a tendency to creep up unexpectedly. Your company tends to get bloated. Also, I've seen a lot of startups, when they get their first big investment, they tend to spend a lot on vanity expenses, and they have oversized offices that nobody's using, etc. These kind of fixed cost creeps can kill you in the future if your revenues are not scaling as fast as you hope that they will. Second, ignoring the impact of CAPEX on future fixed costs. Forgetting about ongoing depreciation, maintenance, and operational expenses. Over-investing in CAPEX too early. Depending on the industry, obviously, in some industries, you need to make those CAPEX expenses. In others, you probably should not. Tying up too much cash in those long-term assets before you have any kind of proven market or stable revenue can really lead to cash flow crunches. Forget about those, vanity assets. You do not have to own your office building. Try and keep it lean until your business model is proven and you're making enough money to actually afford these kind of assets. Another common fallacy is not tracking CAPEX returns. If you're making an investment, you want to know if there's actually some profitability from that investment. So if you're failing to measure, revenue or let's say efficiency gains that were actually generated by your investment, you're not going to know how to analyze future investments. And maybe you want to sell something because there is just not any kind of significant return that you're generating from that asset. Misjudging, the CAPEX versus OPEX trade-off. Making the wrong build versus outsource decision, leading to either an excessive upfront capital drain or some, unsustainable long-term variable costs, or really a lack of desired control and flexibility. I am again providing you with a self-check audit tool to help you assess your fixed cost and CAPEX health. So you'll be looking at your fixed cost structure and your break-even point. Also, I'd like you to assess your CAPEX investment ROI, your overall CAPEX and OPEX strategy, your R&D capitalization strategy, if you have any R&D, and then your fixed cost coverage and your ability to meeting any kind of revenue downturns, etc., and still being able to cover your fixed costs. So download the assessment tool, fill it in, let me know how this goes. Managing fixed costs and CAPEX effectively is not just about financial prudence. It is about making strategic investments that build your company's long-term capacity and resilience. So understanding these concepts will help you to understand and mitigate your company's business model risks. Coming back to the WeWork example from earlier, there is not much that they can do easily about their fixed costs, right? Instead, they must address their insufficient and volatile revenue. Maybe a more pronounced shift away from these cheap single-seat licenses towards hosting a small, medium company as a team, similar to what Regis has been doing forever. This could help WeWork to increase earnings and generate those more steady cash flows that they need to pay for all their fixed assets. I'd love to hear what you think about WeWork. Drop me a comment. Let's discuss this further. So this concludes our deep dive into fixed costs and CAPEX. In Chapter 6, I'll shift my focus to scalability killers and accelerators, and we'll explore the operational bottlenecks and strategic levers that either hinder or supercharge growth. If you found this video helpful, please hit that like button below. Don't forget to subscribe to the channel for more insights on business model innovation, finance, and growth. Leave your comments with me and your questions below. I'd love to hear your thoughts, and I'll see you in the next video.